Hey Shaurya, have you heard about Khurana?
Why? What happened?
He was very ill and got admitted in hospital for a long time. Now he has finally come home, but his treatment cost went into lakhs. Nowadays, hospitals have become very expensive.
Yeah, that's so true. I mean, now India has world-class hospitals and world-class facilities, so this will obviously increase the cost.
Yeah, that's true. It seems hospital companies generate a good amount of earnings. Tell me about some good share of this sector, which will be a strong bet.
Okay, see, you know there are a lot of good companies in hospital sector, but I try to look at dark horse. So today, I will tell you about one such company, and that is Shalby Limited.
Indian healthcare industry is growing rapidly. It is affordable as compared to other Asian and Western countries, and hence demand is increasing. Besides this, policy support by the government and aggressive capacity addition from hospital chains led to the boom in this sector. During FY16 to FY22, Indian healthcare sector grew at 14 to 15% CAGR. By 2025, beds in the leading hospital chain is expected to increase by 30%.
By FY24, the healthcare industry is expected to reach $130 billion. That's because hospital chains are expanding. Besides this, there is deeper health insurance penetration and investment in the healthcare sector, which has increased. Both public and private health spending is increasing. All of this will benefit hospital chains companies. Hospitals account for 60 to 70% share in the healthcare sector. Changes in the healthcare sector are expected to bring huge benefits to some companies. One such company is Shalby Limited.
I don't know anything about this company. Can you please elaborate?
Yeah, relax. I will tell you everything about this company. Listen carefully. Shalby Limited is leading multi-speciality hospital chain of Ahmedabad. It gives services like orthopedics, complex joint replacement, cardiology, and neurology. Dr. Vikram Shah is company's promoter. He has 28 years of experience in medical field. In fact, Dr. Shah is a joint replacement specialist. With total capacity of 2012 beds, the hospital has good expertise in orthopedic surgeries. In healthcare service and industries, the company has a strong market position in western and central part of India.
With more than 1.41 lakh joint replacement surgeries, Shalby is one of the leading joint replacement providers in the world. Each year, this company does around 10 to 12,000 surgeries. In joint replacement surgeries, Shalby has 5% worldwide market share and 15% in private healthcare in India. Apart from this, the company also has a presence in tertiary and quaternary cardiology, neurology, oncology, bariatrics, liver, and transplants. Shalby is looking to expand specifically in smaller cities. In the initial phases, it will focus on Delhi NCR, Kolkata, Maharashtra, Uttar Pradesh, Chhattisgarh, and Assam.
Okay, I agree that the company has a strong business, but right now, is it in loss or profit? What about its valuation and outlook?
Okay, relax. I will tell you everything. Don't worry. See, in the first 9 months of FY23, the company recorded revenues of 605 crore rupees and profit of 53.7 crore rupees. Based on this, the company is expected to earn 805 crore rupees in FY23, and in FY24, company will earn 950 crore rupees, while in FY25, it will earn 1159 crore rupees. With this, let's talk about profit. The company is expected to earn 79 crore rupees in FY23, 101 crore rupees in FY24, and 135 crore rupees in FY25. With this, let's also look at the EPS. So, coming at Shalby's EPS, in FY23, it can come at 7.35 rupees. FY24, it can come at 9.3 rupees, and in FY25, company can earn 12.5 rupees on per share.
Speaking of valuations, market cap of Shalby is 1,460 crore rupees. In FY24, as per FY25, expected EV/EBITDA share is trading at 9 times and 7 times the multiple. The share has fallen 20% from its 52-week high of 168 rupees. Just in 1 week, the share has fallen by 12%.
See, the biggest challenge for Shalby is that it runs, a chain of multi-speciality hospitals. The new hospitals have not been showing very high occupancy levels. So the big challenge for Shalby is that these new hospitals have to show a higher occupancy level, which would make them profitable and which would help them, record the overall EBITDA to the overall gross profitability of the company. So definitely, the company has built a very good asset base. It has got a very sound technical team, but occupancy levels have been pretty low. And once these levels start improving, then I think you're going to see a very massive jump in the profitability.
You are telling just about positives for the company, but there must be some risks for it, no? What about them?
Relax. Yeah, there are risks and we are coming to that. I will tell you about challenges and risks that company face. So listen to them very carefully.
See, the biggest challenge and the kind of challenge for Shalby is basically how they improve the occupancy level on a gross basis, and secondly, how profitable the new hospitals, which are less than 5 years, in their current, basket. So, new hospitals, once they turn profitable, once they start showing a higher occupancy level, only then we could see a massive increase in the operating profitability level. That is the reason, this company has been trading at very low EV to EBITDA multiples as compared to the other hospital, players in the domestic market. But one good part about Shalby is that it's got a diversified kind of basket of, hospitals across, pan India. And we hope that in the next, say, 2 years, the occupancy levels will improve significantly, and that is definitely going to result in good margin expansion as well as the revenue.
Okay, I've understood that the share is trading at an attractive multiple. But what's the guarantee that it will rise in the future? Has experts suggested some target for it?
Yes, I will tell you that. Don't worry. The company has dominant position in business, it has attractive profit margins and well-spread hospitals, and on that basis, share can reach 10 to 12 times EV by EBITDA multiple. Stability in financial track record, strong product domain and credible promoters may lead to re-rating of Shalby. Experts feel that Shalby can be bought at current levels of around 130 rupees.
See, basically, hospital stocks are always going to be valued on a EV to EBITDA basis. So based on that, our EV to EBITDA multiple based on FY 24 and 25 works out to roughly about 8 to 7 times, which is quite attractive considering the kind of exposure this company has got across, several kind of, multi-speciality segments and plus a geographical base. Our sense is that in the next, say, 2 years, this company can easily get an EV to EBITDA of 10 to 12 times. And for that reason, we are looking at a target price of around 220 to 225. So this is definitely a deep value stock.
Now, we have to look at one few more things. It is clear that the treatment costs in the country are increasing, but from investment point of view, it is a good opportunity. Once, the healthcare sector was limited to clinics and nursing home, but right now, situation is different. As now huge multi-speciality hospitals are providing services. Big corporates are entering healthcare sectors and investors are able to invest in such companies through the share market.
Yeah, I got it. So it means that we can invest in healthcare companies through market.